Conviction to me is finding companies in the private sector that are comparable, or other public companies, primarily private, and look for transactions that have occurred. So if there's a company that's in the widget business, and company B that's a private company bought a widget company and paid 7 or 8 times cash flow, and I could get a number of comparables, and I found something in the public market sector that was significantly cheaper than what was paid for it, I start to get my conviction really starts to ratchet up. So comparables are important. Transactions are very, very important. I think what helps my conviction, certain industries I feel more convinced about than other industries. I'm a firm believer that content is a very, very is critically important to what's more important, the company that delivers the product or the company that creates the product. And I'm a firm believer it's the content provider that's critically important. So I have, if I can find a company that's in the media business that's selling at a low multiple of cash flow, and they have great product and great contact and great library, I can feel very comfortable with that kind of business. Other businesses, it becomes more problematic for me to feel that way. So it's industry, it's comps in the private sector, transactions in the private sector. That helps build my confidence that what I'm doing is right. I mean, I can go through, whether it's a Microsoft or any company that has multiple divisions, and I can segregate each division and try to find businesses, similar businesses that have been sold in the recent past, and then try to build a model of what each one of these businesses are worth, subtract the debt, and come up with a valuation on the company. And that's, to me, what really investing is all about. It gains your confidence. A lot of times I'll go into a situation, you do it for 40 years, you can almost look at something and you can say, this is really cheap. And then you go and you try to justify the cheap price. But I would say the odds are very strong. If I feel very strong about a business, just looking at it and glancing at the balance sheet, glancing at what the company has done or is doing and the valuation of it, my decision is almost made then. I have to go out and support it, and supporting it is doing the work. But you do this long enough, you can almost bet that when you look at a particular business and you feel that you can almost feel that it's right almost from the first instant you look at it.
And you have that benefit of this experience.
That's one thing about getting old is good, is you get the experience and you feel more confident about what you do, the ability to go against the herd, the ability to do things that perhaps you would question more 20 or 30 years ago. I mean, you do this long enough, you understand. When markets get crunched, you have to just hold your stomach, and you have to, because everybody, no matter how long you do this, you get that queasy feeling when markets are declining, just as you did in 2008 and 2009. But you have to pull the trigger. So, I think you really have to just, when things look so bad and things are so cheap, you really have to just go out there and you have to put the blinders on, and you have to buy these things, and you can't just buy little amounts. You want to buy big amounts. It's more difficult now to get that kind of feeling with the market at 14,600, wherever it's selling for, than it was when it was 6. Look, there were a lot of things that looked like it looked like the world was coming to an end. But it looks like that during many times during my career. I mean, I think I had 4 great opportunities during my career in the 1970s, 1987, right after the World Trade Center was attacked, and then this past time, 4 times when you should have just really bought and bought and bought. And in each instance, you didn't know it, but you bought things at such, with the benefit of hindsight, you realize, I mean, if I go back to 1975 and look at all those incredible things that were bought, you understood that you should have, just loaded up the cart and bought whatever you can buy. And then conversely, when you have the feeling that things are so overvalued, you really have to step aside and either go to cash, and I know a lot of consultants don't like you to do that, but you got to go to cash and you have to wait for Mr. Market to accommodate you. So if you go back to the late 60s and 1970s when you had this nifty 50, which we talked about earlier on, that were selling at these huge multiples, 40, 50 times earnings. Polaroid was the quintessential glamour stock. Then it was selling at 100 times earnings. You had to step aside and you said, something's wrong here. Price of these stocks are driven up to such ridiculously high prices, you can't buy them. And you don't want to buy them. It's interesting, if you look at the Nifty 50, 20 to 30% of those stocks never reached, ever again reached the height that they reached at the high in the 1970s. So that's lesson learned, real good lesson. And then if you go back again to the late 1990s, you would think people learned their lesson, and you look at some of the big cap stocks, similar to the kinds of stocks that were part of the Nifty 50 in 1995, which was really the apex for these kinds of stocks, they again were selling at incredibly high multiples. I mean, you look at a Microsoft, or Pfizer was selling at 80 times earnings. Microsoft was selling at 60 times earnings. Now, today Microsoft sells, even after the recent run-up, sells at 11 times earnings. Now, I wouldn't have paid 60 times earnings for Microsoft, but 11 times earnings and sum of the parts valuation, a dividend of 3%, which they only pay about 25% of their earnings in the form of dividend, where they can raise that dividend multiple times. To me, that's kind of an interesting stock. Pfizer was 80 times earnings. Yeah, 2 years ago or 3 years ago, it was selling at 8 times earnings. So today it's selling at 11 times earnings. It's not 60 times earnings, and it's still inexpensive. I would pay 11 times earnings for Pfizer today based upon what its pipeline has and its earnings power. So there's a time when you really want to load up the truck. There's a time you don't want to do anything. And there's a time like now you have to pick and choose what's really, what is still inexpensive. They're not going to be the kinds of values that you got 3 years ago. But as we talked about before, there are companies that you can select that still sell at fairly decent discounts to what their intrinsic value is.